if you buy a farm, you go up and look, every couple of weeks to see how far the corn is up, and do you worry too much about whether somebody says this is going to be a year of low prices because exports are being affected or anything like that? You buy a farm and you hold it for. I've got one farm that I bought in the 1980s, and my son runs it, but I've been there once. I mean, it doesn't grow faster if I go and stare at it. I can't cheer for it. More effort, or something like that. And I know there's going to be some years when prices are going to be good and some when the prices aren't going to be good. I know there's years when yields will be better than others. But about the farm, I don't care about economic predictions on it or anything of the sort. I do care that over the years it's well tended to in terms of rotating crops, and I hope yields get better, which they generally have. In fact, that farm 100 years ago would have probably produced 30 bushels, maybe 35 bushels of corn per acre. Now in a good year, it'd be 200. I mean, we've really made progress in this country. That's one reason commodity prices, if you go back a couple hundred years, they've moved so little, is because we've just gotten better and better at whether it's cotton or whether it's corn or soybeans or all kinds of things. And you and I have benefited from that. Well, it's a long-term investment, and if you own the best auto dealership in town, the best brand, and had somebody good running it, you wouldn't drop by every day and say, how many people have come in today, or I think interest rates are going up a little, maybe it'll slow down our sales or anything. No, you buy it knowing there's 365 days a year, and you're going to own it for 20 years, so that's 7,300 days, and things are going to be different from day to day and year to year. You shouldn't buy it if the day-to-day stuff is important. Cash is always a bad investment. I mean, when people said cash is king a year ago, I mean, that's crazy. I mean, cash wasn't producing anything, and it was sure to go down in value over time. We will always have enough cash around, but anytime we have surplus cash around, I'm unhappy. I mean, I would much rather have good businesses than cash, and we found a chance in the last year or thereabouts to deploy. We came in with something over $40 billion in cash, right, and we've got about $20 billion now, and we've had some earnings. So we put a lot of cash to work, and I like that. No, I'd much rather own a good business than have cash.
Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you really gotta grab them when they come, and because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it, and every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company, you didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. It's easier now than ever because you can do it online. Just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one the rest of your life, you would think a long time before every investment decision. And you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.
I think the earned income tax credit is the best way to put money in the pockets of people that don't fit well into the market system, but that are perfectly decent citizens and that have made a good bit of the success, something like I've had with Berkshire or something possible. It wouldn't have happened without the America we have. And if you go back 200 years and we're all working on, 80% of us are working on farms. The person that's the best at that, working on that farm, whatever it may be, is worth maybe twice the ones that's the worst. I mean, that's the difference between super talent and no talent in the farm economy, picking cotton or whatever it may be. Now, if you're the best middleweight fighter in the world, you may get $20 or $30 million. And if you are just a good citizen, raise nice kids, help in the neighborhood and everything else, but you don't have market-related skills. You'd be good on that farm still, and you would be earning something comparable to most of the people around you. But you don't have something now that, as it gets more and more specialized, and it's going to continue to get more specialized. The best moat you can have is your own talent. You know, I mean, they can't take it away from you. Inflation can't take it from you. Taxes can't take it from you. So, when I talk to students, I see these students and I tell them, you know, you're $1 million asset. I would pay you $100,000 to the MBAs for 10% of the earnings for the rest of your life. So that makes you $1 million asset. Now, if you can do something to increase that value 50%, if you can learn to communicate better verbally or in written form, and you become 50% more, that's $500,000 just by improving yourself. I mean, nobody can take that away from you. And so I urge everybody, you know, develop the habits. You've got the brain power, you've got the energy, but develop the habits of success and look around you at the people that you admire, you know, and list what makes you admire them compared to somebody else that looks equally strong or equally talented. And those are things that you can do. I mean, just write them down. And you know, people like people that they like them if they're humorous, if they're friendly, if they give credit to the other fellow. I mean, and they don't like them if they're stingy, you know, or they overstate and overpromise and all those sort of things. Well, that's a decision you make. So I encourage everybody to build your own moat around yourself. The very best businesses are the ones that earn a high rate of return on tangible assets and grow. But even ones that don't grow, if they earn a high return on tangible assets, and then of course if you don't pay too much, they can be a good investment. They're a good business to start with by the high returns. If you pay too much for them, you can turn a good business into a bad investment. But if you pay an appropriate price, you can do all right. Now the big mistake which we made in the early years was to try and buy a bad business at a really cheap price, and it took me about 20 or 30 years to figure out that wasn't a good idea. But this is the car business, the car dealership business, if run well, can be a very good business. You have no receivables to speak of. You floor plan your inventory. You can lease your real estate. We don't do that. We'll own 95% of our real estate. So you can have very little capital actually invested in the business. And you do a large volume. Van Tile, which we bought, has 78 dealerships. They'll average over $100 million a dealership. So you can work on fairly narrow margins and still earn a high return on capital if you don't tie up much capital into $100 million of business.